Let me ask you something. How much tax have you paid in your life? Now think about it. Month after month, year after year, a big chunk of your paycheck goes straight to SARS. And now, as you plan to retire or resign, you're being told that you might have to pay even more tax? Crazy, isn't it? Now, for most government employees, this is a harsh reality. And the worst part, many don't realize that there are legal ways to reduce the tax that they pay. Hi, I'm Devan Naika, the go-to specialist for South African civil servants wanting clarity on whether to retire or resign. Now, today I'm going to be diving into one of the most important topics, my personal favorite, which is tax. And I'm going to be sharing with you proactive tax planning versus reactive tax planning. Now, if you've ever felt frustrated by the amount of tax that you've been paying or worried about how much SARS will take from you on your retirement or resignation benefits, this video is going to be perfect for you. I'm going to show you how proactive planning can save you thousands and sometimes even hundreds of thousands in tax. I'm also going to be sharing with you why reacting too late can cost you far more than you realize. And I'm going to be guiding you on the critical steps that every government employee should take to protect their hard-earned money. Now stay tuned, because by the end of this video, you'll not only understand how to pay as little tax as possible legally, but you'll also know how to take control of your financial future. Now let's get started. I'm doing a quick intro on whether it is legal to save on tax. And in order for me to discuss this, I want to share with you two concepts. The first is, and I've shared on previous videos as well, first is tax avoidance, and the second is tax evasion. Now, this is important because it is a foundation for you in order to save on tax, right? It's also going to help you to understand where tax is coming into the picture, right? Especially if you want to save on tax, you have to first understand why SARS taking that tax from you in order for you to understand how you move to the next level. So let's look at what is tax evasion and tax avoidance. So tax evasion is the illegal part, okay? It's where you are not disclosing something. So you might be earning some type of income, but you do not disclose it. Now, this is the part that's illegal. It's not what you want to do, and it's going to land you into hot water. Now, from your pension fund, whether you choose to retire or resign, remember it's coming from that source. So you really don't, there can't be tax evasion there because it's a pension fund, right? It's coming from a legitimate source. So that you don't have to be concerned about. The next part is tax avoidance. And tax avoidance is the legal part, right? It's where you adjust your finance in such a way that you pay less tax. Right? Now that is the legal part. So this is the foundation that I'm sharing. So what we're discussing for the remainder of this video, I'm going to be talking to you about tax avoidance, right? And different ways in which we can do the avoidance. Now, as a guiding principle, the thing I want you to keep in mind is this. SARS works on a sliding scale when it comes to the taxes. So if you look at the tax guide in terms of the lump sum and how they calculate tax on your lump sum benefits, if you look at the tax guide in terms of how they calculate tax on your income, it is always on a sliding scale. So you would see the following. As your income starts to increase, or the amount that you are taking out on a lump sum, as that increases, then you would see tax to increase. Now, the opposite is also true. If you are now taking less on the income, less on the lump sum, then your taxes become less. So remember, it's on a sliding scale. Now, what determines that leverage for you, keyword, is flexibility. Flexibility. Right? You want to be able to have control. If you're serious about saving on tax, you must have control. You need to be able to adjust the income if you need more and adjust the income if you need less, right? So if you want to save on tax and you can't adjust your income, you can't really save on the tax because you have to pay it, you see? If you want to save on tax and you can adjust your income, then you can take less and then you reduce it, right? We'll go into the differences between the two. So let's take an understanding. What happens on the tax on your income? So at the present moment, you're still in employment and you are collecting your salary. And what's happening basically is, let's look at a tax year. The tax year starts from March and it runs all the way up to Feb, right? So March of a certain year up to Feb of the following year, right? This is how the tax year is running, with the months all in between. And every single month, you are paying a certain amount in tax. Now, I was sharing with you at the start of the video, there's proactive tax planning and there's reactive tax planning. Now, in this case, it is actually reactive tax planning. Why am I saying reactive tax planning? Because here, you are paying the tax. See, you're paying the tax every single month. You almost don't have a choice, right? You have to pay that tax. Actually, you don't have a choice. You have to pay the tax, right? So whatever your salary is, you're paying the tax. That is reactive tax planning, because in the end, when you do your tax return, this is where you would determine, hey, listen, you were getting a refund, right? Meaning inside of the tax year, if you do some tax plans here, it's reactive tax planning because you've already paid the tax. Money's already gone. And now we are looking at how can we ensure we're getting some money back, right? When you do your tax return. This is now the reactive part. Let's go look at the tax on retirement so that we understand how that is. You know that you would have access to your gratuity and you would have access to your income. Now, on the gratuity side, whatever the tax is going to be paid. On your income side, whatever the tax is going to be paid. Which means for this one, it's going to be reactive. You agree? Right? Now, you can't really do anything. If you've paid some tax on your gratuity, you can't really do anything to recover that because it's on a different tax table. If you have paid tax on your income, then yes, you would have to put some tax plans in place to recover that. In which case, it's reactive because you are paying all of the tax and then you are creating tax plans in place in order to get a refund back. Is it making sense? You're having to pay the tax, right? Now, let's flip this around. On the resignation side, now again, I'm not comparing retirement and resigning because you want to get to financial freedom, right? Remember, that's the end result. So I'm sharing with you from a tax perspective how the two operate. On the resignation side, you can access your true 1/3 lump sum. And then you can invest your 2/3 where you can start receiving an income. Now here's the key, and again, depends on how good the planning is, right? Provided you get the right advice, flexibility should be here. If you've watched my video on other channels with members sharing their testimonials, you'll see how I'm creating flexibility for them, right? Or you'll get an idea. So from a lump sum perspective, we could adjust this lump sum, you agree? I could do the tax planning in advance. So notice now, I am being, in this case, proactive. Before you pay that tax, right? Before you pay the tax on the lump sum, I can do the tax calculations to see how much the tax would be. I can then adjust your calculation, you agree? And ensure that you take the amount where you pay the least in tax, right? Or even bring this to zero if you have the pre-98. But there's a number of ways in which we can adjust this, you agree? So I don't have to wait for you to pay the tax. I can be proactive in this. Same happens on the income side. Because the income is flexible, if you're following the plans that I create, right? I mean, I'll guide you on this on the one-on-one session. But say you are going with the plans, now that I'm creating for you, you can adjust the income. And because you can adjust the income every single year, if you don't need a high income, pay careful attention. If you don't need a high income, then we could take a slightly lower income. If you are taking a lower income, then you are not paying the extra money to SARS. Now, I want to go through this very slowly because this is quite essential for if you get this thing right, you can make a significant amount of money, right? Because you can grow that money instead of it going over to SARS. So notice, if in the beginning you needed a high income, and as we work through this, I showed you how to get a lower income, and you now are taking less, it means you're saving on tax. Let's use an example. Say you were going to pay 5,000 Rand every single month in tax, and I showed you how to re-engineer this, and say now you created a saving, you now are paying 2,000 Rand every single month. Can you see you've saved 3,000 Rand a month in tax in my example, right? So because you've got this saving in tax, it's now being proactive, because when it comes to the tax refund, you just haven't given so much extra to SARS. So let's go back on the previous one that I was sharing with you here, right? So in this one, if you are giving 5,000 rands a month over a 12-month period, you've now given 60,000 rand to SARS. And why I say it's reactive is because afterwards you want to try and claim some of this money back. So if you're claiming some of the money back, say you get a refund here of 10,000, then basically you've paid 5,000 every single month and you're getting some money back, right? Whereas here, the goal is instead of paying the 5,000 every single month, what if we could pay 2,000 a month? And 2,000 a month over 12 months, this is now 24,000. In which case, if we don't get a refund from SARS, it's still okay, but you've paid 24,000 for the year. Whereas here, in this example, you've paid 60,000, you got back 10, but you've effectively paid 50, right? And the money that you didn't pay to SARS is still in your investment and still growing. I hope this makes sense. If it doesn't make sense, please rewatch the video, because what I'm sharing with you is one of the key successes, right? If you go through the testimonials, phenomenal results that I've achieved with members, these are some of the secrets that I'm adopting. So make sure that you have a view through this. In fact, comment below, right? If it makes sense to you, what I've shared with you from a proactive or reactive, comment below and tell me it makes sense so I know that you're getting it, right? If the video has been helpful for you, give me a thumbs up so I know that this has been helpful. And remember to click subscribe if you've not already done so for the channel, and to share this video with other members, right? Because I believe as a community, it's important for everyone to work in unison and be strong. I'll catch you in the next video.